Ladies and gentlemen, good day and welcome to the Concord Enviro Systems Limited Q2 and H1 FY26 conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on a touch-tone phone. Please note this conference is going to be recorded. I now hand the conference over to Mr. Kanav Khanna. Thank you, and over to you, sir.
Thanks, and good morning to all the participants on the call, and thanks for joining our Q2 and H1 FY26 earnings call of Concord Enviro Systems Limited. Please note that we have mailed out the results to everyone, and you can see these on our website and also uploaded on our stock exchanges. In case you have not received it, you can write to us. We'll be happy to send it over. And before we proceed to the call, let me remind you that the discussions may contain some forward-looking statements and may invoke known or unknown risks, uncertainties, and factors. It must be viewed in conjunction with our business and could also cause future results or performance to vary significantly from what is expressed or implied. To take the results of this quarter and answer to all your questions, we have the management of Concord Enviro Systems Limited with us. Please welcome Mr. Prayas Goyal, Chairman and Managing Director, Mr. Prerak Goyal, Executive Director, Mr. Anish Goyal, Group CFO, Mr. Sudarshan Kamath, CFO, and Mr. Abhijit Galke, Head of Strategy and M&A. We'll be starting the call with a brief overview of the quarter and H1 gone past, and then we'll follow it up with some question and answers. Now, with that being said, I'll transfer the call to Mr. Prayas Goyal. Over to you, sir.
Thank you, Kanav. Good morning, ladies and gentlemen. A very warm welcome to Concord Enviro's Q2 and H1 FY26 earnings call. Thank you for taking the time to join us today. Let me begin with a quick recap of our company before moving to the highlights of the quarter and the half year. As you know, Concord Enviro has over 3 decades of experience in water and wastewater management and has established itself as a technology-driven, globally integrated solutions provider. Our focus continues to be on zero liquid discharge and energy-efficient technologies that help industries meet their water sustainability goals while optimizing costs. Our business continues to operate across 3 key segments: systems and plants, consumables and spares, and operation, maintenance, and digitization. This covers the entire value chain from design and commissioning to life cycle management. We have also forayed into compressed biogas or CBG systems last year, aligning with India's growing clean energy agenda. In fact, our CBG projects are getting off the block in Q3 FY26. Also, we have a strong and experienced team with us to lead the execution of these projects for CBG. We serve a diverse client base across industries such as pharmaceuticals, chemicals, food and beverages, defense, automobile, energy, steel, and textiles, reflecting the versatility and scalability of our technology. On the R&D front, our 31-member team continues to drive innovation in membrane design and system efficiency. As of this quarter, we hold 9 patents and 21 more applications are under process. Our solutions are developed from first principles, not assembled from off-the-shelf components, which is a key differentiator for us. We are pleased to share some of the exciting technology advancements made during the year. We have successfully completed field trials of our raw effluent membrane, and in parallel, we are developing a new line of heat exchangers based on our evaporation technology, which use non-corrosive plastics in place of stainless steel, thereby offering a cost-effective and durable alternative for a wide range of process applications. Additionally, our team has formulated a proprietary chemical mix to reduce silica content in effluent streams, helping to lower both chemical consumption and sludge generation costs. We have also designed new process schematics for treating high-strength acid and alkali wastewater generated during solar panel manufacturing. Trials for this solution are currently underway with one of the leading solar panel manufacturers in India, and early results are very encouraging. We are also expanding our innovation efforts beyond wastewater treatment into process separations and emerging sustainability areas such as solar photovoltaic, green hydrogen, carbon capture, and semiconductors. where we are partnering with leading industry players to co-develop next-generation technologies. In fact, we are close to signing our first solar PV order for retrofitting an existing ZLD system to value add in terms of performance, OPEX reduction, energy saving, and eventually greenhouse gas emission reduction as the main target. Talking about revenue from operations for Q2 FY26, it stood at 1,248.45 million compared to 1,618.94 million in Q2 FY25. The year-on-year decline is optically due to an exceptionally strong Q2 FY25, which had a significant billing from our Mexico project back then. Also on the project execution front, we have faced an unexpected delay in one of our Africa projects due to pending approvals from local authorities. This has temporarily deferred execution and revenue recognition. Consequently, we are revising our FY26 revenue growth guidance from 18 to 20% to now around 12 to 15%. While this has impacted our short-term performance, we remain confident that project execution will normalize in the coming quarters and contribute meaningfully to growth thereafter. As of September 30, 2025, our order book stood at 5,354 million rupees. Segment-wise, about 53% of this pertains to zero liquid discharge type projects, 15% to compressed biogas systems, and the rest coming from the operation and maintenance contracts and spares and consumables. Additionally, we are in advanced discussions for new projects worth approximately 2,700 crores with encouraging conversion prospects. Our significant new product launch has been the raw effluent membrane, or the REM product. This is a revolutionary new membrane system which can treat raw effluents directly by membrane in tough applications such as paper, textile, food and beverage, and several others. Use of this REM membrane majorly simplifies the treatment and reuse process for our clients, saving them energy, chemicals, reducing sludge, and more importantly, reducing the use of valuable real estate. With increased penetration of the REM product, we will have a significant competitive advantage in the marketplace. We also recently participated in the IFAC water event in Mumbai this year, and we are glad to share that we received an overwhelming response at this event. Looking ahead, we remain encouraged by strong structural tailwinds, rising regulatory focus on wastewater discharge, increasing importance of water security, and growing ESG commitments by global corporations. These trends reinforce our long-term growth potential and leadership in sustainable water solutions. With that, I'd now like to hand over to Mr. Prerak Goel, Executive Director, to walk you through the financial performance for Q2 and H1 FY26. Thank you.
Thank you, Prayas. Good morning, everyone. As stated earlier, our revenue for the quarter stood at 1,248 million. This is up 22% from the previous quarter, but it was down 23% year on year. As Prayas mentioned, this was primarily due to the large billing that we had in Q2 FY25 for the Mexico project, which did not contribute this year as some of the export projects were H2 heavy. Additionally, the EBITDA without other income stood at 77 million compared to a loss of 9 million in the first quarter and 273 million in Q2 FY25. The year-on-year decline in absolute terms reflects both higher employee costs. This is mainly due to ongoing leadership and business expansion with the CBG and carbon initiatives for the business and the elevated base from last year's export order. This obviously is in conjunction with the delay of the Africa project, which is impacting some of it. So we do also want to revise our EBITDA guidance. We expect about a 1% down from the EBITDA targets that we had set for the year. PAT after discontinued operations stood at 45 million compared to 51 million in Q1 and 189 million in Q2 FY25. For H1 FY26, revenue stood at 2,272 million, EBITDA at 68 million, and PAT after discontinued operations at 86 million. This is compared to 129 million for the same period last year. While the near-term performance reflects the impact of the Africa project delay, our order visibility remains very strong. We are confident that the strategic investments we are making in talent, technology, and execution will enable us to deliver sustainable long-term value. With that, we now open the floor for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Balasubramaniam from Arihant Capital. Please go ahead.
Good morning, sir. Thank you so much for the opportunities. On the margin side, EBITDA margin have been compressed in H1 nearly 3% compared to 11.6% in last H1. I think in this H1 is basically lower based and having the lower higher fixed lower fixed cost absorptions. I think in H2 maybe 60 to 65% kind of weightage will be there. Whether we can able to achieve double-digit margins in H2 and we can able to maintain nearly 14 to 16% kind of margin in overall in FY26.
Hi, thanks for your question. Yes, I think we're quite confident. As I said, I think it's about a 1% hit in EBITDA, what we expect. So, we should be in that, I think the earlier guidance was about 16 to 17%. So we should be between the 15 to 16% given the projections. And as you said, the H2 order execution that we have based on the order book that we currently have and some of the orders we expect to close in Q3, we should be in that 12 to 15% sort of revenue growth range. So that's the maximum impact that we see. So we are confident that we will hit the margins and the top line that we are now kind of giving out because these are backed by orders and pretty much in the advanced stages of execution.
Okay, sir. So CPG project starting from in Q3. And what is the current timeline for revenue recognitions from your initial CPG projects? And with a target of 3 to 5 industrial projects per year, maybe 100 crore kind of potential, what is the scalability and the margin profile of this segment compared to your core ZLD business?
Yes, you wanted to talk about the CPG?
Yes, sir. Yes, sir.
Yes.
CPG projects.
Yes. Yeah. So, we have penciled in about a 45 plus crore top line in the next 2 quarters. So, in terms of execution of 2 of the 3 industrial projects, in terms of the kind of industrial pipeline for CPG, we're seeing a lot of exciting kind of openings which are coming across, wherein the industry already has access to captive waste, which has been one of the major kind of factors which has been ailing this industry. So that is going to bring us a lot of security in these projects. So the pipeline remains strong. In terms of the margin profile, we see it being relatively similar in terms of EBITDA contribution to our revenue.
Yeah, and just on the large projects as you had asked. So yeah, generally we have about half a dozen larger projects that we would execute during the year. So currently for this year, we had projects in Africa, which out of which one of them has faced a little bit of a delay in terms of the civil startup approvals. So because of that, it looks like the civils will only get underway in Q4, and which may impact revenue recognition in this financial year. So that's the reason why the revenue recognition has been revised. Barring that, the other large projects that we are currently executing are on track.
Okay, sir. On the order book side, order book remains flat, nearly 535 crore kind of range. And how this order book visibility and what is the inquiries, especially in domestic and international markets? And you mentioned about the African project has been shifting to next year, financial 27. And what kind of inquiry levels, especially we are getting from Africa and Middle East levels? And is there any shift to USD denominated contracts impacting your competitive positioning in these regions? And secondly, you mentioned about L1 lower bidder in 400 million order in nuclear sector. And
Sorry,
what is that?
400 million?
400 million nuclear sector order.
Nuclear, yeah. Sorry, yes.
Yeah. So, what has been your conversion rate from L1 into the final awarded year? Is there any timeline for this such process in the government or PSU sector?
Right. Yeah. So I'll just start with your So just let me start with the nuclear bit. This is a seawater desalination tender that we have. We are L1 in that tender, and it's generally about a 2-month process for the government to kind of convert that into an order. So we are currently expecting this to order to materialize end of November, early December, and execution period will be about 8 to 9 months for this particular project. So yes, on the desalination side, there is a lot of focus both from industry and governments to tap seawater along the coast for the industrial requirement. And again, in conjunction with the projects that we have completed for Davis Laboratories, for Sterling and Wilson for a project where they were building a solar power plant and they wanted water for rinsing. So we definitely are consolidating our position around the seawater desal market, especially for these small to mid-size requirements. Just in terms of, you also talked about the pipeline. So I would like to say that, I think India is seeing a very strong focus in terms of growth and the inquiry pipeline that we're getting from large corporates for investing in water recycling is very, very strong. I think, the relationships that we've had with the large corporates, especially people like Tata Motors, Tata Steel, we're reaping those benefits today. And I think, we continue to focus on these inquiries. Also, if you're aware that India is kind of launching certain recycling obligations to large water consumers, so that will also kind of help the business in the oncoming years. So the inquiry pipeline in India remains quite strong. Internationally, we continue to focus on key markets like Mexico, South Africa, where the local governance or the local standards that the countries are implementing in terms of wastewater discharge have been becoming more and more stringent, and the implementation of this is being kind of now being focused on by these countries. So, for example, Mexico will go by March 27. They have obligations for a lot of the industries to meet the new standards. So as a result of that, in Mexico itself, we're talking to some of the large alcobev companies, the food and beverage sector, something like yeast, to be expecting a large order as well. So there is a lot of discussion happening in markets like Mexico. Africa is another area where there is a lot of development happening and a lot of green capital flowing in there, which then requires companies to follow good practices in terms of their zero liquid discharge. So that continues to see strong focus as well.
Okay, sir. So my last question, the 7.5 TPT carbon capture projects, I think it's a key proof of concept. And what is the targeted commercial in this business in terms of sale of systems, carbon credit sharing, and the services side? And what are the key regulatory or technological milestones that would trigger a broader rollout beyond FY27?
Yeah, so thank you for that question. It's a very interesting focus area for us, and the deployment of the first commercial pilot is going well, and in Q4 we should be stabilizing that pilot. Consequently, we expect kind of revenue to come in H2 of kind of 27 from there on. The pipeline again there is very interesting across a wide range of industries, driven largely not only by regulatory but also by kind of more voluntary requirements from export-driven markets and also local clients looking to switch over to eventually to greener solutions. So we do expect on the technology side there have been good improvements in terms of our yield ratios for the biological system that we are kind of deploying. So yes, we request you all to please stay tuned to get more updates on this in the coming quarters. Thank you.
Got it, sir. Thank you.
Thank you. The next question is from the line of Kunal Ochiramani from Alpha Alternatives. Please go ahead.
So my question is on business side. So there are a lot of countries those are making membranes, RONF, UF, and MF. Countries like US, Japan, Korea, China, Germany. And when we talk about desalination or any other process, so there has been disconnect with the market, and we want to understand the technology you guys have, which is what we claim is little different, or what is the moat we have, what is the core competency we have that we exist in broader markets like Mexico or even India. What is our core competency in this business?
Yeah, thank you for the question, sir. Our core competency and our moat really in these businesses are twofold. Firstly, is coming out of our product and our IP-backed product, which is solutions such as differential membrane, different plate and frame type systems which we manufacture. So it's coming out of the hardware, let's say, number one. And number two, it's coming out of our knowledge of these industrial wastewaters, the application development that we make, understanding what contributes to the pollutant load in the wastewater, what kind of solutions need to be made. So we have, through decades of piloting and R&D on this subject, we have a huge body of knowledge and expertise in these areas. So these are two things which contribute to really building a very strong kind of, you can almost say, a pull from key clientele in understanding that these are the kind of solutions that they need, and is what is driving kind of global value seekers in terms of recycling and zero liquid discharge to kind of look to Concord to provide them solutions.
So this is the experience we have with the clients, I understand. But can we quantify in the sense of efficiency, how are you placed with the global players versus the global players? Are we any better in terms of efficiency or cost? Like we've said, we are cheaper, 10-15% cheaper to global guys. But simultaneously, are we more efficient? Why would any customer choose us? Just to understand on business front.
Yeah, sure. So I'll just maybe take another minute to bring you back to the fact that India has been one of the leaders in zero liquid discharge and recycling. So if you look at the global marketplace, on a global scale, India is the leader. And the kind of technology and experience that we have in reuse and zero liquid discharge, to be very honest, is not there on the global side. And as a result of that experience and that head start which we have in India and companies such as us, we are able to provide in certain cases a very massive advantage to the client in terms of operating costs, where the technology that we provide can lead to up to a 50% operating cost advantage in many cases. And in zero liquid discharge, the kind of the life cycle operating cost or the annual operating cost is the key driver for any customer in the decision making. It's not just the capex, where obviously given our lower cost ways coming out of India, we are competitive compared to global players on capex. But more importantly, on operating costs, that's where the customers try to do the life cycle cost analysis and then say, hey, this is a significant saving, and that turns out to be the key decision making factor for them in choosing a partner or supplier.
Sir, and in terms of efficiency, are we any better?
We are miles ahead, sir.
Can we quantify, because desalination needs some 99% and more of efficiency?
Yeah, I'm talking in general about zero liquid discharge, sir. But yes, in terms of desalination, for example, I can say that if you compare the recent order wins that we've had, our captive power requirement has been at least 12 to 18% lower than what the other bids our customer had received.
Thank you so much. This answers my question.
Thank you. The next question is from the line of Sonia Varnekar from Dalal and Broacha PMS. Please go ahead.
Hello, sir. Thank you for the opportunity. So firstly, I want to understand what is the size of this African project which saw delay in approval? And secondly, you have revised your FY26 guidance lower. So you expect this approval to come in FY27 for that African project. So what is your guidance for FY27?
Thanks, Sonal. So the size of the project was about $6.7 million. And it was broken up into a bit of local civil works and supply of equipment. At the current moment, we expect the approvals to come into Q4 of our financial year here. So we expect to start civils somewhere in that quarter. So there will be, let's say a minor revenue recognition coming into this quarter, maybe to the extent of about $1 million, and the balance, about 5.7 million, is what we expect to grow next year. I mean, in terms of execute next year. So we've not kind of worked out detailed numbers. We go through our budgeting exercise closer to December, so we don't have a finite FI budget. But I think in conjunction with the growth aspects that we see generally year-on-year growth, we are kind of still looking at 18-20%. There's nothing which has changed our forecast for growth. It was just the export orders, as we always have said, that we have longer visibility for these, because these are generally executed over periods of 10 to 12 months, sometimes even longer. So just from our export pipeline, which we have, export order book at the current moment, this has kind of seen a little bit of a slippage. So it should help us in exceeding some targets in FY27, but I think it's too early for me to give you a guidance on that. Once we have our internal meetings and numbers, we can probably give us more. And I think probably in the Q3 earnings call, since we'll have completed our budgeting activities, we'll probably be more, probably correct on the numbers.
Okay. Thank you, sir.
Yeah.
Thank you. Participants who wish to ask a question may press star and one on the touchtone telephone. The next question is from the line of Kunal Ochiramani from Alpha Alternatives. Please go ahead.
Also, I wanted to understand, thank you for taking me back in the queue, but regarding CBG project, what is the competency again here we have? Because a lot of players in the market are doing. I understand we have a capable team. So in terms of are we getting the raw material cheaper to make the or what is the competency and what will be the margins, what will be the asset turns we are expecting in terms of what we are investing and what we are getting?
Sure, Kunal. Thank you for the question again. So yeah, I think in terms of competency, other than the team, other than the fact that we've been delivering biogas projects for the last 3 decades. So this focus that we have on industrial waste, Kunal, is basically to say that we are focusing on areas where the industry is itself generating organic waste, which today is being sent for external disposal. And in many cases, that disposal comes at a cost. So you can say there is a negative cost for waste. So we are not relying on any feedstock for the CBG plant or the biogas plant coming from any external source. It is an internally generated waste today, which is in complete control of the company, right? So that is the main focus of our CBG plant.
Mm-hmm. And in terms of margin, should we be better?
In terms of margin, I mentioned earlier.
Compared to.
I would say they're range bound in terms of the similar EBITDA are kind of profile to our core business. I would say in terms of our SNC or our variety.
Fair enough, sir. Sir, and in August con call, you said that you aspire to continue at 20% growth, and current year might be a shift of revenue to next year. But as I understand, there is no order loss or revised expectations in terms of numbers. So it was kind of hinted that we should reach 1,000 crore top line, but it was not explicitly guided in FY27 call, and current capacity should do a revenue of 1,300-1,400 crores. So do we still stand at the same guidance, 20% growth and somewhere reaching the current capacity utilization by FY28 or 29?
Yeah, I think long term, that is what we are looking at. So I think even from the capacity expansion perspective, yeah, I mean, with the new investments that we'll be putting in from the proceeds that we raised in the IPO, getting up to 1,400 crores is not a problem. And the long-term guidance remains at 20%. We see the business growing very strongly over the years.
And thirdly, sir, you said some 20 odd crores is available for further tech and licensing deals in last con call.
Yes.
So just wanted to understand what are these licensing deals and how will this benefit us? Are there any things on table, and when should we expect this?
So we have.
Yeah, there are a couple of advanced stages that we are. So in the current quarter, we expect to kind of deploy some of these funds. The focus remains more on technology licensing, more value add in terms of solutions, which bring in not only technology but also some ability to do some contract manufacturing as well.
Mm-hmm. And how should this benefit us?
The benefits will be mainly in terms of applications, in terms of the competitiveness of our solutions. As I mentioned, in being able to open up new sectors in terms of industrial wastewater reuse and zero liquid discharge, and thirdly, like I said, also add some top line in terms of contract manufacturing as a licensee.
Mm-hmm. Sir, a couple of bookkeeping questions. So Sharjah is 9% tax rate. So what should be our effective tax rate for next couple of years? And secondly, like we've had forex losses in terms of peso and USD hedging. So will we expect any forex losses, or this has been contained from now on in next 2-3 years?
Yeah, I think we've done two things in terms of forex losses. At least whatever we have an exposure on the books currently, we've tried to contain as much as possible. So whatever hedging and everything that was possible to be done and a system set up to monitor that has been put in place. I think this year, because the peso has appreciated against the USD, there has been a significant gain in our forex loss. So the forex losses we had last year, we've almost overcome them. So obviously, whatever was the real forex loss that we had last year was accounted last year, but at least whatever was the unrealized has kind of got reversed and changed. The long-term policy from a group perspective, what we've done also is that we have switched our order currency mainly to US dollars. So wherever we are taking new orders, the exposure for supply of equipment, which is done from our India and Sharjah entities, is all going to be dollar denominated, and only the local works in terms of the installation, in case it's a EPC, then the civil, that will continue to be in the local currency, which will obviously then not impact us on the forex margins. So that's the plan going forward, and I think even if you look at the projects in Africa, etc., we follow the similar model. So yes, we don't expect anything large. We just need to manage the USD INR risk that we would be having as an organization. So your first question, the first part of that question was
tax rates.
Tax rates, yes. Sorry. So in UAE, the 9% corporate tax is for entities which are doing business. So just to clarify, we are a free zone establishment. So in UAE, what they have said is that if you're a free zone establishment, you're eligible for tax only if you're doing work in the mainland. So if I'm selling from our free zone into Dubai or into UAE, then I'm subject to tax. For all revenue where I am exporting goods outside the country, the tax rate is not applicable to us. So we continue to enjoy a tax-free benefit in the UAE. This is as of the laws at the current moment. Given that our profits are split equally between the two jurisdictions, we expect the average tax rate to be between the 12 and 14% sort of a range. And obviously, this should keep fluctuating as projects keep moving, right? So depending on where the larger order base is coming from.
This should be the larger 12 to 18% tax rate for next couple of years, I assume.
It looks like by the segment-wise revenue in terms of exports and what we're doing in India, I would say between 12 and 14 generally would be the tax rate, the effective tax rate for us.
Sir, and also I understand that we moved all the contracts to USD, but what is the policy of hedging? Do we book the hedging rates at the day of booking the orders, or how does it work?
No, so I see there is always an order execution cycle and the payment cycle depending on that. So we can only book the hedge once we have a sort of a crystallized cash flow from those projects. So basically when we have invoices where we can actually have the final date on payment, that's when we can typically hedge. It becomes very difficult and expensive to hedge a project upfront at the time of getting the order because cash flows might move depending on the project cycle. So yeah, it is basically done once the payment is available and confirmed. So on that basis, then we start doing that. We also obviously have a lot of imports in USD. So on the import side, we typically hedge everything that we have a liability that has to be paid for once the orders are in.
Thank you, sir. This was very helpful. Thank you and all the best.
Thanks.
Thank you. Participants who wish to ask a question may press star and one on the touchtone telephone. The next question is from the line of Aditya Arora from P4 Capital. Please go ahead.
Good morning, Prayas and Prerak. Just a follow-on question. How are you seeing this consumable spare parts and O&M business growth, which in the last 6 months and for the next 6 months, and even going forward? That's one part of the question. And second was, if we split the revenue for FY26 and 27, say first let's start with 26. Are you seeing ZLD or system business largely flat this year versus the previous year?
Okay, thanks Aditya for the question. So I'll just answer the first part of it. So see on the O&M, I would say a lot of the large projects that we done last year, especially like Mexico, they went into O&M gradually from Q2. So Q3 and Q4 we will see that O&M getting pretty much solidized. All the plants will be working there. So that will obviously boost up revenues. Even in India, some of the large projects that we've done are currently in commissioning and handover phases. So we see some growth in H2 from our O&M business, and that's how we are kind of forecasting the overall growth for the year. Trading in spares remains strong. We've been also given that for the Mexico projects there will be some spares that the clients will procure from us for their ongoing maintenance, etc. So we see that to be quite strong as well. The third-party O&M business also is doing well. We've got some good traction there. So I think last quarter we'd spoken about a project that we'd got from a large EPC player. So that kind of, we're consolidating that position. We're hoping to get more contracts from that same player for other projects as well. So that the O&M and spares is obviously a big focus area. We wanted to kind of grow to 40-45% of revenues. As we always say, it's kind of the best contribution to the bottom line as well, and gives us a lot of insights into client workings. In terms of the revenue forecast for the current year, I think obviously the export business was lumpy last year as well because we had this large order from Mexico. So if you look at what's happening is that the Indian business segment has been growing. The exports will probably shrink as compared to what we had last year. So given that, we should be at about a 14 to 15% sort of a growth for the full year basis on the systems and plants business. Yeah, and we generally see that kind of growth coming in from each of the segments. So I don't see a flattish kind of a thing, but you will see a shift between exports and domestic.
Got it. Okay, thanks.
Thank you. The next question is from the line of Vineet Mehta from Ashika Group. Please go ahead.
Sir, our follow-up question is on basically outlook. So with new R&D processes coming and new CBG project coming, so 26 you have said that 14 to 15%. But what about 27? Like, what do we expect in 27, 28 going down the line? Like, what will be the growth rate in CBG projects, and if the starting range of CBG projects margin is 14 to 15%, how when it gets on full scale, how can you leverage it more further? Like, will it go more 100 basis, 200 basis points ahead? And what will the implications of that new R&D projects you have taken, which will also boost margins? So what will be your margins going? What are the targets for margins going forward?
Yeah, sure. So I sorry, just answering your questions in parts. So I think just on the growth profile, so as I said earlier as well, I think, see, overall, we don't see any change. We do see 20% sort of growth rates that we should be able to achieve, going forward. So while we have not done our exact budgets yet for FY27, I think the general guidance and the sentiment in the country, and given the kind of inquiries that we have, the growth targets for us remain in that segment. In terms of the margin profile, especially for CBG, see, we've been doing a lot of the biogas projects, even the Mexico project, a large biogas project. Right now, also, we bid for a large biogas project in for wastewater in South Africa. So there is a lot of projects that we do for biogas. Now, tuning that to CBG, the core technology is the same. You still need the same tanks, the same systems to set up a CBG plant as well, because the biogas piece is almost similar. And then you need some specialized equipment like compressors, etc., to concentrate that gas and clean the gas. That's where CBG gets a little different from the industrial biogas projects. So, I think starting off, we definitely seeing that, because we'll have a core team which will be running the CBG project. There will be some local site works that will be required. So we kind of expecting a 14 to 15% sort of a margin. It will increase as we keep doing more projects, the more scale that we get, more multiple projects running together. So I think we can definitely increase our project base there. As I said, for any business that we like to run, we generally like to target about 18-20% sort of EBITDA numbers over longer term. So we like to enter the businesses if we see that being scalable and possible to get up to those numbers. So that continues to remain our target. But yes, as we scale up, we will continue to look at what's the best numbers that we can get. It's also market dependent, as Prayas said. This is a solution that we're giving to a lot of industrial clients who have captive waste. So it's about getting the project economics right for them, so that they can invest in these projects and actually get a return from their waste. I'm sorry, did I miss any part of your question?
No, that was part of it. Yeah, thank you.
Okay, thank you.
Thank you. Participants who wish to ask a question may press star and 1. As there are no further questions from the participants, I now hand the conference over to the management for the closing comments.
Thank you, everyone, for your time on the call today and the questions. We look forward to connecting again in the Q3 call. Thank you.
On behalf of Concord Enviro Systems Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.